Welcome back to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Phil Trepetowski.
And I'm James Sivko.
I'm not exactly sure how I'm going to explain what's going on in the world right now, but I'm going to do my absolute best. We're going to talk about consumer sentiment and what they say versus what their actions are. Oil prices, those are all over the place, but the standard is they're moving higher. Inflation, has it gone up yet? Not really. Does it look like it's going to go up? Probably. Rate expectations, tax refunds, and where they're at right now. And then my final monologue, complaining while buying. Mr. James Sivko and Phil Trepetowski here to tell an amazing story this month. Let's go into our dealers' results.
If you enjoyed this video, hit subscribe. It's free, and we want to make more videos that you love for people just like you. Thanks for the support.
March was a heater, and it was a welcomed heater after a tough January and February. New sales, absolute rocket ship month over month, 18.2%. But when we're looking at year over year, not overly special by any means, down about 9.5%. Used sales, even though they've already been steady, they've been doing quite well. Used sales up 7.1%. Now, one thing I want to talk about, what's happening at these auctions right now? I believe just about 2.5% increase in prices during the month of January. I think 2.7 during the month of February, 3% in the month of March. So we can essentially say that we're almost up 10% coming into the month of April. And according to my dealers as of last week, it's not stopping. So if you're a dealer that only a couple months ago was paying 27 grand for a car, it's sniffing 30 grand, and you're wondering how the hell you could pay 30 grand and make any money. And the answer is, I don't really know either. With that said, let's go over some macroeconomic updates for you. Gentlemen, go ahead.
Consumer sentiment is plunging, and we have just printed, as of yesterday, a 45-year low in the University of Michigan Consumer Survey of Current Economic Conditions. These two lines rhyme. The orange line is sentiment. The blue line is auto sales and a seasonally adjusted rate. This is a giant chart. It's 50 years of data, and we're at all-time lows. So if we zoom in on the last 2 years, I think we have a really interesting trend here, and that is consumers are complaining. So they're registering among the worst survey results in the last 45 years. But we just had a couple of great prints, including March. Like you said, a heater, 16.3 million. What we think this is consumers, at least half of them, are unhappy with the administration and are just using every opportunity they have, whether it's a survey or a vote or something, to just complain and to just say that everything's wrong and everything's terrible. But I think we can now divine from the data that despite this collapse in consumer sentiment that is now 8 months old, where we have great prints in the auto industry, we think that consumers are just complaining while buying. There were a lot of headlines in the last week before filming. We had a single day 20% drop in the price of crude oil. That, of course, is a precursor to gas prices. It's in this chart somewhere, but gas prices are high. They're volatile. The trend is probably, unfortunately, still up because the oil market, it's a heck of a symphony. It's 99 million barrels of oil that have to arrive every day in the right quantity, in the right quality, to a willing buyer who has credit at the right place, and it's got to move across all the oceans. And so we have an ongoing shortfall, whether we have a ceasefire or not. And so expect high, sticky gas prices at the pump.
Mr. Sivko, so I took a look at how long it takes a ship, a tanker, if you will, to get all the way over here to the U.S. I believe, if I'm not mistaken, I heard it was compared to the normal pace that somebody would be riding a bike at. It's about the speed of one of those tankers. And it sounds like even if the Strait of Hormuz was open today, all those tankers that are stuck have quite the amount of time to get over here to the U.S. or other destinations across the world. Is that correct?
Yeah, multiple sources of the shortfall. First of all, the bigger source are just kind of the things we blew up, or they blew up, or everyone blew each other's stuff up. And then there's this extra 15 days that it takes to sail these things in the wrong direction. And then finally, hundreds of these things remain trapped in the Strait of Hormuz. And it looks like right now the regime is only letting them out a few at a time. and from selected countries that they are friends with first. So this is going to be an ongoing problem. There's a lot of oil floating, as the industry likes to call it. It's floating on one side of the Strait of Hormuz and it's got to get to the other.
What does that mean for consumers, James?
Crude prices have actually a big effect on consumer balance sheets over time. So whenever you get a spike in crude prices, you will see an upturn in auto delinquencies. This auto delinquency measure is mostly prime borrowers. You can see that the upturn that we've had has caused this dark blue line to rise a bit. Again, this is just prime borrowers. So right now we've gone from 1.8% prime delinquencies to 2.0. It's really not that big of a deal in terms of getting cars sold and getting multiple offers for a loan and all that kind of stuff. The credit's available. If this continues, the price will change a little bit, and the price will change a little bit for prime borrowers, which is always disappointing because that's the biggest volume that everyone has, or are these people with good credit ratings. They might be charged 25 basis points more to make up for some extra delinquencies that show up.
How is all of this uncertainty translating into inflation predictions?
Inflation predictions are rising, and they were very steady throughout the whole first part of the year. And then bang, the war starts, things get kinetic, and first week in March, they start to march higher. And here we just have this graph. This is just Goldman jumping out in front of everybody else on Wall Street with a much more aggressive inflation prediction. Maybe they know something that we don't know. Those inflation levels translate very quickly into short-term interest rates. And those short-term interest rates, as we know, affect the price at which everyone is going to borrow to buy a car. In terms of rate cuts, they were a theme, and they have been a theme all year long until the war broke out. And so now, instead of having 2 cuts priced in, now we have really no cuts priced in, with maybe a chance to get a cut between now and year end.
James, if I was a betting man, I feel like this is a 4-seam fastball coming right at me to head over to Kalshi and maybe throw 100 on the 1.2% there and just see if I can come out with 10 G's. What do you think?
Absolutely. Look, I mean, there's a bet that pays, it looks like 80 to 1. That insurance is pretty cheap. You can get a lot of leverage there. You can get a lot of leverage in the futures markets if you want. It's cheap to bet on a rate hike. And I think that a rate hike, if oil prices stay volatile and high, is much more likely than the market's pricing in now.
I feel pretty good about my reads on Filski, and while you were talking there, I could see him peeking over to one of his other monitors. I feel like some money might just have gone down on that bet.
I will neither confirm nor deny that statement.
Speaking of betting markets, the betting markets, of course, are running a will we be in a recession this year market. And man, that's just been moving around. You can see with gas prices. And so this is just something that we're getting whipped around on. This is a market implied probability. So these are bond prices, stock prices, and a bunch of other inputs. Has us at about the traditional 12%, which is where it should be. So right now, financial markets, which are a little different than betting markets, financial markets are at 12%, which is, this year is just like every other year. You're going to be in recession about 1 out of every 8 years. Betting markets happen to be taking a view and are up in the mid 20s. And then, of course, we've got this Goldman forecast where maybe they know something that we don't know. They're taking a view.
Certainly some headwinds that the industry is going to have to navigate as time moves on. But James, let's talk about a tailwind, and that's been the tax return season has been quite strong thus far.
Tax return season has been great. This graph here, 2026, you can see that it's better than 2025. We're a little bit behind the 10-year average, but we have a lot of data. The number of returns that we've gotten, the number of returns that are still pending, the number that are in process, we know that we're going to beat the average here. So we know that our orange line here is going to catch up to the green and blue line. It's like really late in the forecast. So this is something it's already baked in the cake. We're going to get $100 billion more in tax returns over the next 30 days, like we do every single time this season. And that's a lot of cars that can get sold in the next 30 days with these tax returns. And the other variable we got to look at is the size of them. Now, we were promised tax returns that were going to be 33% bigger, I think. And we still have a very respectable 15 to 20% bigger tax average refund size. This is the check size that consumers are walking into the dealership with. It's about 20% higher than it typically is. A great tailwind over the next 30 days to sell some cars.
To wrap things up, For this April's update, we're officially living in a market of extremes. We just saw a March performance that was, frankly, a great print by every metric. New sales surged over 18%, with the used sales freight train chugging along. But at the same time, we're watching consumer sentiment probe 45-year lows. It's a strange new world of complaining while buying. Your consumers are walking onto the lot telling you the economy is in trouble, and then they go ahead and reach for their pen and sign. Why? Because day 54 did exactly what we predicted. It flooded the market with liquidity. And the best is yet to come, as Mr. James Sivko referenced earlier. Over the next 30 days, we're looking at $100 billion in tax returns hitting consumer pockets. That is the single largest bridge we have ever seen to help your customers cross the negative equity gap that is staring all of us in the face. But you have to move with urgency because this fog of war has turned into an absolute oil shock. We're watching crude oil verticalize. We know the math. When gas prices spike, delinquencies follow, and consumer defensive posturing kicks in. Right now, your customers have the cash from the IRS, but they are terrified of the pump. My challenge to you this month is be the solution to their fear. If they're scared of gas, fine, show them the used EV bargains, which are converging at $25,000 each. If they're scared of a recession, show them the value of getting out of their high interest debt while they still have a record tax refund to act as their down payment. The money's there. The sales momentum is also there, and don't let the headlines talk you or your customers out of a record-breaking spring. On behalf of my esteemed colleagues, Mr. James Sivko and Phil Trivitowski, my name is Steven Georgella. Who the hell knows what's going to happen except for next month's Automotive Market Minute. We'll see you then. Out.